Etsy shares are down after the company, which sells small handicrafts to buyers on its websites, reported gross merchandise sales that disappointed investors. The company reported record revenue, but still fell short of analyst expectations. Let's talk about it with an analyst who covers the stock. Sean Dunlop is equity analyst at Morningstar, and he joins us from Chicago. Sean, thanks a lot for joining us. I think you're constructive on this stock, and we can get certainly to that. Today, the market is unimpressed, and the shares have really melted down since late 2021. This was actually a $300 stock back then. Very, very briefly, it's now roughly, I think, a $55 stock. And some analysts, the analysts at Bloomberg Intelligence, for instance, are characterizing this as a challenge with discretionary spending. So, first of all, are your views on the macro backdrop here? Is the company struggling against negative discretionary spend trends?
Yeah, absolutely. I mean, I think if there's a one sentence takeaway from the quarter, it's that consumers remain really value sensitive. They continue to seek deals, and that tends to pressure companies like Etsy that sell an extraordinarily discretionary product suite. So I was certainly disappointed by quarterly results. I think that was pretty uniform across the street. I'd expected $162 million in revenues. We got 851. I'd expected $3.86 billion in GMV. We got $3.7 billion. Across the suite of brands, not just Etsy, but Depop, which is apparel resale, and Reverb, which is musical instrument resale, we saw gross merchandise volume decline 6.8% year over year. So that's about a 13-point delta with broader U.S. e-commerce growth. And what we really see is consumers, if you look at the Amazon results, you see that their unit sales increased 11%. Their nominal sales at the company level increased only 7%. That means you've got about 4 points of compression from average sale prices, or consumers sort of trading down the menu, if you will, with e-commerce. And that's what we're seeing with Etsy's results, I think.
But you are constructive on the stock. You believe that the company should return to double-digit top-line growth. I assume that's revenue growth in a normal discretionary spending environment. So why don't you talk about that?
Yeah, it's absolutely true. So I think there's a couple areas that the market misunderstands about Etsy's business model. It's very easy to look at GMV declines in the mid to high single-digit range and say that this is a business that's impaired. I think it's probably more appropriate to say that consumers want to spend money at Etsy. They just feel very constrained as they've seen the sort of inflation that we've seen in a lot of non-discretionary spending categories. I think sort of the two big areas that investors tend to miss are that the cohort composition, the Etsy buyer base, is actually getting quite a bit healthier. So the headline churn figure is about 55 or 60% annually, but most of those are people that only make one purchase per year. Among buyers that make more than a purchase per year, the churn rate is closer to 25%, and we're still sort of cycling through those pandemic cohorts that should continue to get healthier over time. And then I think the second piece that people tend to miss is that it's really easy to look at Etsy's results and assume that they're losing a ton of market share when you see the outsized growth that we've seen in broader U.S. e-commerce. I think the truth is, once you adjust for the categories that they play in, 35% of Etsy sales come from home furnishings, for instance, which have been uniquely depressed. Another quarter come from apparel. Those market share losses pretty much go away. And then you add in the fact that e-commerce growth has been slower in some of the other Etsy geographies like the United Kingdom or Germany that have been navigating downturns, and they've actually gained a modest amount of share over the last 12 months. So results are tough. We think things get better when the broader consumer discretionary spending environment improves. But we have pushed that out 2 quarters to now the third quarter of 2026, based on our chief economist's forecasts for the U.S.
Okay, you also have a fair value estimate of this on this stock of $100 per share. That's roughly double where we are right now. It's at 52.27 right now. What kind of earnings assumptions, sales assumptions, and valuation metrics do you use to get to $100?
Yeah, absolutely. It's a great question. So as we alluded to earlier, we think near-term pressure is pretty stout. We forecast about a 2% GMV decline in 2025, as if to say things probably don't get better for at least 4 quarters. And then we expect a pretty sharp rebound thereafter. So by the second half of 2026, we expect the firm to be taking market share in broader e-commerce. We have a 5-year GMV CAGR of 8.9%, a 10-year GMV CAGR of 9.6%. Both of which would suggest that Etsy's taking market share on the top line. Now, as you move down the P&L, from a revenue perspective, we expect them to continue to be able to grow that ad services business. That was one bright spot from the quarter. So we do expect to see a bit of take rate expansion. And then given the really scalable nature of the model, the only real variable costs that they have are cloud service arrangements and payment processing, about 30% of sales. We do see a really viable route to low 20s operating margins if our growth assumptions are correct. So all in, that gets you to a 10-year CAGR for operating profit of about 19% and a 10-year CAGR for EPS in the mid-20s, 24 to 25%.
Sean, thanks a great deal for this conversation. That's Sean Dunlop.